Hello, welcome back, guys. So I did make a video about PayPal when they had their earnings report, and the stock looked pretty cheap back then. I was potentially thinking of adding some to my portfolio. Then it kept going down a little bit, and I kind of wanted to wait for like the 3-day rule, just see how this reacts. And it looks like it kept going down, and it has lost what, like maybe 15 to 20% in the last few days. Now, the stock, even though the stock has been dropping like a rock, the financials of the company are pretty solid here. And their earnings report was actually pretty nice. And despite that, the company kept dropping in terms of their stock price. And this actually prompted me to buy. I had to pull the trigger and I bought 80 shares today. I bought at 61.2 USD. And I think it's a fantastic price, frankly. We are going to talk a little bit about what is going on here, why is this dropping so much, and why I do think it's a great opportunity here for the long run. Now, if you take it back 5 years, the company was sitting at about $300, which is incredible. It's down almost 80% since that time, and so it's a fantastic entry point right now as we're sitting at about 61. Now, this happens a lot with companies. When it was near $300, it was obviously pretty overpriced. And when it starts dropping, it's dropping and dropping and dropping. It kind of reverses the sentiment of things being normal and the company's stock price going up and up and up and up. And so people actually tend to dump it more for sometimes no reason. The sentiment becomes negative, nobody likes the stock, everybody is dumping. And this is when a savvy investor kind of comes in and, they're asking themselves, okay, this company is making a lot of money for its price. And so this may be deserved of a potential buy here. And that's what I'm seeing over here. And this is why I'm also making this video, just to let you know that I bought this one right now, basically like an hour ago or so. Now, the P ratio of the company is sitting near 30 right now. That's a trailing PE. But remember what I talked about in the previous video. If you take a look at the income statement, you will see that the net income of the company has been almost half what it was a year ago, which is sort of like a temporary thing. We have seen it with many tech companies, and not only tech companies. They have suffered through the pandemic, through what happened with the economic issues that countries basically were facing. And so this is a temporary thing that really dropped the stock. Now, imagine if they go back to normal, this PE, basically the forward PE, drops down at a tremendous pace, and maybe it drops down to 15 or 10 even in some situations. And so you may be looking at it right now and it may look a little expensive, but it's not. And even if it was 30, it probably wouldn't be that expensive already. Because remember, this is not Walmart, this is PayPal. A fintech company is not the same as a company that is, selling on retail. It's a completely different thing, and it sometimes makes sense to buy even at a higher price, let alone when it goes down that much and it's actually even cheaper than Walmart. This looks insane, frankly. Now, I'm going to talk about a couple of articles which I thought they were very interesting to take a look at. And this article is talking about how PayPal is beyond dirt cheap. And yeah, it's definitely pretty dirt cheap, actually. I kind of agree with this one, as the stock is dropping tremendously and its fundamentals are still pretty solid, is the nice thing about it. I kind of want to see them buying even some shares back, even more shares, actually. They are already buying back shares. I think like 5% is what we talked about in the previous video, something like that. But still, I think they would actually, this would be a prime opportunity for buying even more at this price, frankly. Now, you will see that PayPal was overbought and overvalued around its highs, what I told you earlier, when it was like more than 300. Yeah, it was massively overpriced back then. And then, again, the sentiment changes and people keep dumping the stock. Now, instead of rallying, PayPal stock dropped like a rock through to a new multi-year low after its earnings result, primarily due to a downgrade from the experts at Credit Suisse Bank, if they can be called experts. I mean, I'm not even sure if this business bank is going to exist in the next few years or so. Probably it will. But yeah, these kind of downgrades and upgrades don't really mean much for the long-term, guidance of the company, pretty much. And now, as the article mentions, we're looking at 11 times the consensus forward EPS estimate, what I talked about earlier. As the company goes back to its normal net income, pretty much, we're going to be a much stronger, increase in revenues as well. And so this is looking pretty awesome for the upcoming few years, I suppose. And so it's pretty cheap. Now, from a technical standpoint, the author mentions that this is a buy. From a technical standpoint, practically means that the stock has been sold too much, so it's time to buy. That's what it practically means. All these metrics, like the RSI, for instance, the MCD, the stochastics, the Bollinger Bands, all these metrics are about how much the stock has been sold or how much the stock has been bought. So it's almost acting like a rubber band telling you, okay, this has been sold so much that it's time to bounce. That's all these metrics are telling you, frankly. And also there are some metrics that are telling you there's a base over here. It's acting like a floor, so probably the stock will be going up from here, especially compared to what the company has been doing in the past. This is kind of, in a nutshell, what the technicals are about. And they do have some merit because they are about trader psychology. But for a long-term investor, we don't really care so much about these things. We do care, though, about the strong earnings, even in tough times. And so PayPal delivered pretty awesome EPS over here and beating on everything, as you'll see. Beating on revenue estimates, beating on EPS, beating on guidance as well. They raised their full year guidance from 18% to 20%. And remember, PayPal has been a company that has almost always been doing 18% of growth. So they're raising that as well. So this is fantastic here for an investor. Again, as an investor that is actually looking at the long term, this is looking pretty awesome to me. And so the stock tanking, as the article mentions here, is all about the sentiment. It's basically about pressures that are affecting profitability in the near term, margin pressures, for instance. Again, things that we have talked about for so many other companies. Meta had similar issues and they were overspending as well. Very normal things, companies going through this kind of market cycle right now after we had a pretty big crash in the overall economies, frankly. And this allows investors that are, don't really care about the short term to actually enter this company at a fantastic price. And this is why I bought today. Another article that one of our members in our Discord channel mentioned here, and I thought it was very interesting because it talks about the financials in a little bit more detail, is this one. And it's talking about PayPal being an investment thesis here, and a good investment thesis actually for it, because the business is growing, the financials are getting better, and yields are enormously high for the sector. And so conservative guidance is what PayPal has already given us here. And remember, they actually launched PayPal and Venmo at McDonald's restaurants and signed a deal with Microsoft that brings the buy now, pay later option and Venmo wallet to the Xbox store. Big things here. And remember, PayPal, I mean, people may forget easily as they are looking at this kind of bearish sentiments here. PayPal is everywhere. Businesses are using PayPal in some situations. It's almost like a monopoly. So it's not just eBay that was using PayPal. There are so many businesses, and in so many businesses, it's actually even the core player or the only player. So this is something that you shouldn't be forgetting. It's difficult to remove the habits of people, and it's difficult for somebody else to take the place, like 100% take the place of PayPal here. So that's probably not going to be happening anytime soon here. And this article is talking about revenues here, and still, while there is some revenue growth, they are looking at maybe lowering a little bit the forecasts. But you will see that even with a little bit of lower new projections, we're still sitting at a pretty nice growth level, at pretty nice growth levels here. Even if that goes down a little bit lower than we would expect, it's still pretty nice. And a sustainable trend in consumer involvement growth and as number of transactions per active account are rising. And this is another thing that I mentioned in the previous video, the fact that transactions are rising. And this is super important for companies of this sort. This is the thing that matters. Having more transactions and having a higher load is super important, and it's what is happening right now with PayPal. So margins continue to get better, and how could they be worse when the company has been losing so much net income in the past year? We do fully expect this to keep happening, for the margins to continue rising over here. And as you'll see, again, the EBITDA is another thing which is similar to what the old projections were. As you'll see, kind of here, still increasing at a very nice pace, the EBITDA forecast for the company. And EBITDA is a fancy way of saying, let's take a look at the earnings without accounting for interest taxes, depreciation, and amortization, pretty much. And it's used in some situations for companies of the same industry to exclude some of the expenses that are, I should say, not similar in some situations and can skew projections, can skew the understanding actually of a company, the financial understanding. Or to put it simply, it's just a way to exclude expenses, make the company look better in some situations, frankly. And I have talked about it in previous videos as well. Now, after the post-earnings sell-off, PayPal's valuation sets new lows and the yields set new highs. When we get to the valuation side, a huge question arises why PayPal stock is currently valued at such a low price. And I don't myself ask so much why this is the case, because it's clear that the case is the sentiment. The company has been dropping tremendously since the financials are pretty solid right now. But I do ask whether I should be buying, and I frankly fail to see a reason why I should avoid the company at this current valuation. I just don't see it. And PayPal's buyback program, another one that I talked about, 4 billion, which gives a buyback yield of 5.5%, which is almost twice that of Coca-Cola and higher than Philip Morris. And another great thing to see, and frankly, I would like them to keep buying and buy even more, because I do think that this is too cheap right now to avoid, even for the board. This is where the board, a sensible board, comes over and says, okay, we need to be buying back our shares, this is cheap. Because they can utilize these shares to actually pay their employees even. I mean, that's one of the reasons why you are buying back shares. And you're dropping the amount of outstanding shares in the market, and basically you can potentially even reissue later for paying employees. It becomes an interesting proposition. It's always nice to drop the amount of stock that is out there, because then investors are happy because their stock is worth more. Now, if we take a look at our stock evaluator, you will see here why the stock is very cheap. Now, the company has usually been doing about 18%, as you'll see here. Last year was the odd one out. They didn't do that well, but still increased their revenues. And we're expecting something like 20%, right? Remember, their year-over-year projections for the fiscal year was about 20%. I'm going to go much lower, though, because I like to be conservative. I will go 10%, 12 and 14. Oops, let's go 12 and 14. And some people may actually go even more conservative. Obviously, everybody who has access to my tool over here can take a look and do their own projections. All our patrons have access. So if you're interested, you can go to myinvestorsheaven.com or just InvestorsHeaven in Patreon, not PayPal, and just sign up, and you can get access to the tool and try your own values basically with any other stock as well. And the net income margins, remember, they have been dropping, but they will be increasing. And frankly, they are probably going to be something around 15% or so. I will try a few different values here. I will go, 9 is not going to happen. This was the odd one out. I will go 12, 13, and 14. And remember, that's a 5-year one. And for the free cash flow margins, I will go 18. Actually, the company is doing more than 80. They usually do more than 100, frankly. So I will go 100, 105, and 110, which I think makes much more sense. And annual return of 13%. And I hit calculate, and you will see where we are right now. This has become so cheap. I didn't expect that, frankly, that the highs over here with a 14% revenue growth, which I think is pretty easily achievable. All these metrics here, they look fairly normal. And we're sitting at 87 over here right now. And for the medium ones, which are much more conservative, we're sitting at 71. And the low ones, even more conservative with lower margins, at 58. I don't think the company will just do 12% for the next 5 years, frankly. But still, even if they do, that's 58, and I bought at 61. So I'm fine. Because remember, I'm buying a company that's pretty fantastic as well. And this matters too. I mean, the fact that the company is a key player in the space. It's dirt cheap compared to its actual financials. Also, margins, no debt, frankly, or actually they have some debt, but it's serviceable easily. They're making great cash flow. They're expanding. This is a great company, and remember, this is not a retailer. This is a big fintech company over here. And this valuation I just can't avoid, and this is why I bought. I could consider buying even more in the future. We'll see. I'll let you know if that happens, because frankly, there are too many opportunities, and I don't want to go overboard on a single stock. But this may be one that deserves it potentially. Thanks for watching, guys. I'll see you soon. I'm basically almost done with my studio over here, so you will soon see me full blown, with a full frontal, like with my face and everything. I'm preparing for that, so stay tuned. Remember to leave a like and subscribe, and I'll see you in the next video. Bye bye.